Hello everybody, today's June 4th, 2010, and I wanted to make a quick video on derivatives today. Not a lot of people understand what derivatives are, and by no means am I going to try and make everyone watching this video totally understand them. They can be quite complicated. Some of the smartest financial minds and economists don't even understand all of them fully. A lot of them, the problem with that is a lot of them are generated by computer models, so they get to be extremely complicated. But they work real well, and they can be very profitable if you're on the right side of the derivative. The problem is they use such high leverage that if you're on the wrong side of the derivative, you can wipe out a lot of capital really quickly. I mean, I trade on the Forex market a little bit. I dabble. I just kind of got started. I follow gold, and I can see where there's opportunities in the gold market, and betting against the euro. You know, with the euro falling apart, I think you can make some decent returns betting against the euro. So anyway, with a few $100s, I've been dabbling in the Forex market, and what's really incredible is that you can use 100 to 1 leverage. So I can put just $50 in my account, on margin, and I can control $5,000 worth of gold. So real small price increases, and I can control a lot more gold than what I'm dealing with. Now, this is similar with derivatives. There's huge leverage, and the problem is, when you're on the wrong side, like the credit crisis that we had. When we were said it was due to subprime and bad bets on Wall Street and this and that. The main reason that we had the crisis in '08 is because of derivatives. AIG mainly was brought down by derivatives, and Lehman Brothers. AIG, derivatives are like an insurance, form of insurance. So AIG had huge exposure through derivatives, and they were on the wrong side of the bet. When the housing market started to collapse, they were on the wrong side of the bet, and things fell apart really quickly. So anyway, there's all types of derivatives, and like I said, I'm not going to try and have you understand derivatives through this video. There's other videos, people explain it better than me. The main reason I wanted to talk about derivatives was to kind of give an idea of how big the market is, and the potential that this market has on us. Now, there's futures, options, swaps, there's all type of derivatives. I mean, you and I could bet on whether Joe's going to default on his mortgage, and we can make a little derivative contract, whether he defaults or not. I mean, there was a lot of that going on prior to '08, that AIG was involved in. And they were wrapping up derivative contracts and selling them as credit default swaps and collateralized debt obligations, all these fancy names, and they were selling them to foreigners, and so they got the rest of the world involved in these, in the U.S. housing market. So anyway, to have an idea of how big this is, if you look at all the stocks in the world, you're talking about a $36 trillion market. And then if you look at the world bond market, you're talking about a $72 trillion market. Now, if you look at the United States national debt, it's around 13 trillion, and our future unfunded obligation is over 100 trillion. So, you talk all these different trillions of dollars. The world GDP, gross domestic product, everything produced in the entire world is 62 trillion. But when you talk about the world derivative market, you're talking about 1.4 quadrillion. That sounds like a huge number, and it is an extremely huge number. You get up to numbers like that, it's like, whatever, okay, so it's a really big problem. Now, put it in perspective, 1.4 quadrillion dollar market. It's like 40 times the world stock market, all the stocks in the whole world. It's so much bigger than the bond market. There's 20 times the world bond market. So it's such a huge problem. What's going to take to bring the second phase of the crash? They stopped the first phase. I mean, I sort of see Bernanke standing in front of Hoover Dam, and there's all these little tiny holes that are starting to spew out water. And the derivative market is the water on the other side of the wall. And here he is plugging these little holes, holding interest rates at zero, bailing out this, giving money to the IMF, bail out Greece, and doing all these different little things. He's just standing there. He's only got so many toes and fingers. So, like Buffett says, it's a ticking time bomb, the derivative market. He said that before, months ago. He just came out and said that again. When he took over General Ray Insurance Company, he paid billions of dollars to get out of the derivatives because he didn't understand them. He doesn't like to be in things that he didn't understand. That's why he missed out a lot on the tech boom. But, Buffett's one of the richest men in the world, if not the richest man in the world. I don't know, he keeps battling with Gates back and forth. But he says they're a ticking time bomb. So, I don't know what it's going to take with currency crisis or whether it's going to be some other countries starting to default. But we're talking about a $1.4 quadrillion market, of which 85% of that is on interest rates. There's all type of derivatives. Well, 85% of the $1.4 quadrillion market is on interest rate swaps. So, it's really scary thinking about it. And what can you do about it? Well, I think you can hold physical metal. I mean, that's as this whole paper monopoly game comes crumbling down around us, and this whole credit market. There's so much credit been dealt out and paper money been printed. I definitely want to be holding some real money when the crap really hits the fan. So that's it for now. Hope that gives you a little bit of perspective on the derivative market. It's such a huge deal, and I don't see anybody covering it. A little bit here and there. But everybody, this should be something that everybody's talking about, the derivative market. But I don't know anybody talking about it.